Inflation is slowly coming off the boil. The Consumer Price Index recorded an annual increase of 5.2% in April. This is down from 5.3% in March and 5.6% in February. While this is a positive move for inflation, the figure is still some way off the Reserve Bank's target of 4.5%. The SARB has repeatedly reiterated that it will not move its policy rate lower until inflation is under control and sustainably hitting that target. Anglo American's rejected a third takeover bid from BHP, but it's opened the door to talks with its larger rival and has agreed to a one-week extension for a binding offer. Anglo says the latest proposal includes the same highly complex structure as the bids that were previously rejected, as it still requires a demerger of Anglo American's interests. Anglo has previously dismissed this condition and says it continues to believe that there are serious concerns with that structure because it will likely result in material completion risk and value impact that disproportionately falls on Anglo American's shareholders. Southern Sun says it's been a record year for profitability. The hotel operator has booked an 88% surge in annual adjusted headline earnings per share. That's thanks to benefits from the restructuring it started during the COVID-19 period and the exposure of its hotels in the Western Cape to a strong tourism, business travel and event-related year. Given the performance, the group has declared its first dividend as a standalone company. Shareholders will receive 12.5 cents per share. Challenging, that's how Spear has described the past year as it navigated tough trading conditions. But the real estate investment trust still managed to grow. The firm increased annual revenue by 5.9%. This, coupled with consistent cash flows from operating activities, prompted Spear's board to approve an annual average payout ratio of 95% for the year. A total distribution per share of 78.8 cents has been declared. That reflects a 3.8% increase. Life Healthcare's balance sheet is in good health. The private hospital operator has posted a 30% rise in headline earnings from continuing operations at the halfway stage. This was helped by a 7.8% uptick in revenue from continuing operations. That was driven by robust activity growth in Southern Africa. An interim dividend of 19 cents per share has been declared. That's up 11.8% from a year earlier. RFG has bagged profit growth. The owner of Heinz Spices has reported a near 21% rise in half-year headline earnings. That's as the group was able to recover inflationary increases on raw material and packaging costs and extract cost savings from operational efficiencies. Looking ahead, RFG expects consumer spending to remain under pressure as interest rate cuts are seen coming to the fore only in its 2025 financial year. To counter this, the business says it will keep driving sales and brand share growth through a heightened focus on product innovation, particularly in the fruit juice and dry foods categories. Pick n Pay has warned of a plunge into the red. The grocer expects to report a full-year headline loss per share of between 177 and 228 cents. That's due to a 2.8 billion rand non-cash asset impairment of Pick n Pay supermarket stores. Alongside the trading update, Pick n Pay also provided insight into its recapitalization plan. The firm says the strategy is being refined by the board, shareholders and regulators, but it is progressing. Pick n Pay plans to hold a rights offer mid-year and will seek approval for this at an extraordinary general meeting of shareholders towards the end of June. The firm has also concluded a debt restructuring agreement with its short-term and long-term lenders. This secures the group's liquidity and funding up to September. The proceeds from the rights offer as well as funds from the listing of Boxer will be used to pay debt, which stood at 6.1 billion rand in February. Given these moves, Pick n Pay has developed a new strategic plan, which it says it will present to shareholders when it releases its annual results on the 27th of May. Further afield, inflation in Britain fell by less than expected, prompting investors to cut their bets on a Bank of England rate cut next month, which could have given a boost to embattled Prime Minister Rishi Sunak before an election this year. Here's more detail in this package report.
UK inflation fell by less than expected in April. Consumer prices rose by an annual 2.3%, down sharply from a 3.2% rise the month before. It was also the lowest since July 3 years ago, according to official data released Wednesday. But both the UK Central Bank and economists had forecast a bigger drop to 2.1%. Services inflation was much higher than expected, while petrol prices also rose. One investor said core inflation, which takes out energy, food and tobacco, came in stronger than expected. Sterling jumped after the data was released. Wednesday's update also led investors to cut their bets on a Bank of England rate cut next month. Market watchers priced the chance of a cut in June at just 18%, way down from 50% a day before. Recent labour market data has brought mixed news on the price pressures front. Private sector wage growth, excluding bonuses, eased only marginally in the 3 months to March. The central bank is concerned rapid wage growth could sustain inflationary heat across the economy.
Now, as European Parliament elections approach, political and public discourse intensifies. This as Germany's right-wing party AfD continues to advocate for exiting the EU bloc. Here's our reporter Nathi Ndevu with more.
Well, that is right, Zinati. As Europe heads into the upcoming elections for the European Parliament, some political voices are not just arguing over the future direction of the bloc, but whether or not the bloc is worth dealing with. Now, the Germany right-wing AfD party has often promised to take the country out of the bloc entirely. There's, of course, been some backlash here and there, but more importantly, this has broader geopolitical implications. And Lars Halter, who is with DW, joins me now from Berlin. Lars, what can you tell us?
Thanks for having me. Yes, indeed, the AfD party has often said they would like to see Germany leave the European Union. You could call it a Dexit, I suppose. After all, we've had a similar scenario in 2017 when the Brits left the bloc in what was then called the Brexit. That, by the way, came after a nationwide referendum when an ever so slight majority of Brits voted for the country to leave the bloc and going its own ways. It was supposed to save the Brits billions of pounds every year. That's what politicians told them, but it hasn't worked out at all. And now, with similar talk from a German party, economists have run some numbers, and one sticks out right off the bat. Within 5 years, according to the experts, Germany would see its gross domestic product drop by 5.5%. They're saying we would miss out on around 690 billion euros in the national value chain. And that in turn would negatively impact, of course, the job market and spread into every sector of the economy. And then, of course, also people's lives.
Lars, you mentioned a forecast GDP drop there and this Dexit having an effect on people's lives. Maybe paint a picture for us on why it would be so expensive for Germany to drop out of the EU, with the knowledge, of course, that the country is the largest economy in the EU's continent.
Mostly because Germany is, more than many other countries, depending on trade. We are an export-driven economy, and good trade relations are key, obviously, when selling lots of product across borders. Of course, even without an EU membership, Germany could sign free trade agreements, but that would be a very long process, likely stretching over decades, and there is no indication that any new trade deals with former EU partners or with outside partners like the US or Canada or countries in Asia or Africa or elsewhere would bring any new advantages. Also, it's almost unthinkable what would happen if Germany switched back to its own currency, dropping the euro for the old Deutschmark or whatever a new national currency would be called. The currency would almost certainly be weaker than the euro, and that again would make imports more expensive. Again, another disadvantage for a nation with a lot of trade.
And last, since we've already seen a country exiting the EU, how are the Brits doing?
Oh, it's been terrible for them leaving the EU, that is. And even those who drove the country out of the bloc at the time have now admitted that. Take Nigel Farage, the populist leader behind the Brexit movement. He has said that the whole thing wasn't successful. Sadiq Khan is the mayor of London, and he has recently commissioned a study that looked into the numbers behind Brexit. Apparently, leaving the bloc has cost the Brits 6% of their gross domestic product. That comes out at around 163 billion euros per year. And this is not even the worst. Those 6% are expected to rise to 10% by 2035, also according to economists. The UK economy also lost millions of jobs, which economists are tying straight to Brexit. So we do have a very clear cautionary tale here.
Well, let's leave it there for now. Thank you so much for those updates, Lars. That was Deutsche Welle's Lars Halter.